Whether you're a shopkeeper or a government employee, your financial capability, risk level, and goals are different, so your investment choices should match your situation. Here's how you can understand what to choose and how to choose it wisely, depending on your income type. For a shopkeeper, income varies month to month. Goal: extra income, steady growth, less risk. Best option: 1. Mutual funds, good choice. Start with SIP, Systematic Investment Plan. Even 500 rupees per month is okay. Choose balanced or hybrid funds, mix of shares and safe bonds. Example: ICICI Balanced Advantage Fund, HDFC Hybrid Equity Fund. 2. Large cap shares, safe companies. If you want to buy shares directly, choose big and stable companies like Reliance, Infosys, TCS, HDFC Bank, Asian Paints. These are safer than small or unknown companies. 3. Avoid risky shares. Don't chase cheap shares or hot tips. Focus on quality, not quantity. For a government employee, income, fixed and stable every month. Goal: long-term wealth, future security. Best option: 1. Mutual funds, aggressive or SIP. You can invest higher, 1,000 to 5,000 rupees per month or more. Choose equity mutual funds for long-term growth. Example: Mirai Asset Large Cap Fund, SBI Blue Chip Fund, Axis Growth Opportunities Fund. 2. Direct share investment for extra growth. Use part of your money to invest in shares of top companies. Stick to Nifty 50 companies or dividend-paying stocks. 3. Mixed strategy, safe plus growth. 70% in mutual funds, for growth, less effort. 30% in shares, for direct learning and profit. How to choose the right one, for anyone. Step 1. Know your risk level. If you can handle ups and downs, equity mutual fund or shares. If you want peace of mind, hybrid or debt mutual fund. Step 2. Know your goal. Short term, 1 to 2 years. Safer funds or fixed deposits. Long term, 5 to 10 years. Mutual funds or shares. Step 3. Start small and learn. Start with 500 rupees per month in mutual funds. Slowly explore direct share buying with 1,000 rupees or 2,000 rupees. Knowing which companies are safe and which are risky is one of the most important parts of smart investing. Here's a simple guide to help you do basic research and understand whether a company is safe to invest in or not, even if you're not a finance expert. How to know if a company is safe, good to invest. 1. Company size, market capitalization. Safe, big, well-known companies, called large cap companies. Example: Reliance, TCS, Infosys, HDFC Bank. These companies are stable and grow slowly but steadily. Second, past performance. Check if the company has been making profits regularly for the last 5 to 10 years. See if its share price has grown slowly and steadily, not just suddenly. Where to check? Websites like Money Control, Screener.in, or apps like Grow, Zerodha show charts and financial results. 3. Debt, loan, status. Safe companies have low or manageable debt. Too much debt equals risk of going bankrupt. On Screener.in, look for debt-to-equity ratio. If it's less than 1, it's generally okay. 4th, promoter holding. This means how much of the company is still owned by its original founders. If promoters hold more than 50%, it's a good sign. If they're selling their shares a lot, it may be a bad sign. 5. Dividend payout. Safe companies often pay dividends, a part of their profits, to you. Regular dividends, steady income, healthy company. How to spot risky or unsafe companies, 1 unknown or small companies. Penny stocks, stocks priced at 1 rupee, 5 rupees, or 10 rupees may seem cheap, but many are unsafe. These can be manipulated easily. 2. Sudden jump in price. If a stock jumps 50 to 100% in a few days without news, it's suspicious. It may be pump and dump. Someone is artificially raising the price to trap others. 3. No profit or negative news. Companies that make losses every year or are in the news for fraud or court cases are risky. 4. Low liquidity. If very few people are selling the stock, it may be hard to sell it when you want to. Easy research plan, even for beginners. 1. Google the company name plus financials. Example, TCS Financials or Adani Power Financials. 2. Use screener.in or moneycontrol.com. Look for debt-to-equity ratio, less than 1 is good. Return on equity, ROE greater than 12% is good. Profit growth, consistent. Promoter holding, greater than 50%. 3. Watch YouTube channels for simple learning. 4. Read news from reliable sources websites like ET Markets, Money Control, Bloomberg Quint show updates.